All right, let's get into it. We got a lot to discuss for today. I've been out for a couple of weeks, but I missed it. I'm ready to get back into it and talk about this multifamily, especially the market right now. So there's been some interesting articles, some interesting discussions that I've had, especially from D. Good morning, D. And so what we want to do right now is just sort of talk about it. The state of the market right now. The multifamily market is changing. We've had drastic changes in interest rates. There's been a lot of turmoil. There's been people who have lost massive portfolios in the multifamily space. Is the blood in the streets? Like, should you get away? Should you still be looking for deals? Should you still do deals? We're going to be discussing that right now. So if you are attending this live and you are on the chat, go ahead and briefly just let me know where you are watching this from. Where in the world are you? Just go ahead and comment that real fast and we'll go ahead and get started. Good morning, Anthony, David. Good to see you there. So for those who don't know me, we do this every week. We talk about everything multifamily. My name is Jason Stubblefield. I've been buying apartment complexes since 2016, and our portfolio has been a little over 1,000 units now. And we're still looking to grow that, actively pursuing deals right now. So that may be a hint of what's to come. But just want to sort of give you an introduction about what we've been doing here for the past few years. So for those who want to know just a little bit more about me, I'm going to share my screen right now. Hopefully you can see that. This is realapartments.com. That's RIL apartments.com. And we've recently switched niches, so we're still in the apartment space, but we focus a lot on impact investing and affordable housing. If you want to know more about what we're doing, rilapartments.com is where you can find out about that. If you go over to the Invest Now button and you click on that, we still actively do deals. If you want to hear about those deals, if that's something you might be interested in, just click on that Invest Now. It'll bring you to this page right here. There'll be a brief form for you to fill out. You fill this out and either me or somebody from my team will reach out to you. We'll have a brief discussion, see if what we're doing is something that fits your needs, and we'll sort of see if we're matched, and then you'll hear about deals that we have coming out. So if not, you may not hear about the deals that we're doing. So just want to let you know that. And let's see. So what do we have here? All right, Dallas, Texas, Houston, Texas, El Paso, Texas. What is going on in Texas? Irish, we might just have to move to Texas. We got a lot of Texas attendees coming in. And then let's see, we got Atlanta in the house as well. So all right, good deal. So let's go ahead and talk about this a little bit. First of all, there is a correlation in between interest rates and cap rates, right? And so that's going to be the foundation of what I'm going to be discussing here today. And so with that, I'll just do a brief recap of what cap rates are and how that plays into this. You should know what interest rates are, but I've done extensive videos on that. If you want to see something else, maybe you can just check that out or let me know, and I can send you a more detailed explanation of cap rates. But if you were to buy a deal, all cash, meaning there is no bank involved, if you were to buy that deal, how much money as a return on investment would you make? That is essentially what a cap rate is, right? So if I'm buying $1 million property and it makes me $100,000 a year in net operating income, then that would be a 10% cap rate, meaning that I just put all the money up myself. So that's a cap rate. Most people, however, are not buying deals in all cash. And so that's where you get into lending, and you have lenders who are charging you an interest rate. All right, so this will probably best be detailed if I just give share a screen with you so I can illustrate this a little bit better. So let me go ahead and do this, and let me check this out. Yes, I want to do presenting. Okay, so let me know if you all can see this. Put it in the chat, or Iris, let me know. Is this showing up right now on my screen? Y'all seeing this little graphic? My wonderful illustration here. the magic is happening. I'm gonna go with yes. Let me check over here. Okay, all right. I got plenty of yeses. All right. Excuse me. I got multiple screens over here, so I don't know who's seeing what, and I got to look and get it from somewhere. So okay, so you got this cap rates here, and what can I do here? Oh yeah, this my little laser, and let me put it in. Let's go with blue. All right. So cap rates and interest rates. So this relationship, this has basically been our world over the last, I don't know, call it 6, 7, 8, 9 years, where cap rates, even though they've been going down, they have been higher than your interest rates. So you may be able to purchase a deal, say back years ago, you may be able to buy a deal at an 8% cap rate. Well, you could borrow money at probably 6%. And what has happened is cap rates have come down. They compressed a lot. And so at today's world, right, in today's market, there's 5, this may even be 5 or sub 5 for our cap rates. But interest rates historically have been going down as well. And so you saw prices in multifamily continue to go up. I don't know why I just lost the whiteboard there. Let me bring that back. But you saw prices in multifamily continuously go up, right? Despite what was happening in the market, right? So even though we saw these cap rates declining, interest rates were accompanying it. And so that allowed deals to still work. So when you have this spread right here, this delta in between the cap rate and the interest rate, when cap rates are higher than interest rates, it's easy or easier to make money, right? Because just you're earning, say, a 8% cap rate and your interest rate is only 4%. Well, you get the profit off of that spread, not to mention value add strategy or whatever you're doing. So it's easier for deals to go well. And even though multifamily has been continuing to skyrocket, right? Even though that's happened, some people have said, well, it's oversaturated. Years past. But what happened is interest rates were going down as well. And so you're buying a property at a 5% cap rate, but you got a 3% interest rate. There's still a delta there. But what happened recently? So last year, around March timeframe, the Federal Reserve started increasing interest rates. So where we are right now is probably on the graph on the right? And we saw interest rates climb dramatically. And so where we are right now is we are over here where cap rates have not come down. Okay, this is my funky arrow. It'll be gone in a minute. But this is the space that we're living in right now, where cap rates have not gone up. Let me correct that. Cap rates have gone up, but they haven't gone up as drastically as interest rates have gone up. So our interest rates are now higher than the cap rates. And so what does that mean when you're here, right? So now you're buying a property still at a 5 cap, maybe a 5.5 cap, but you've got to go try to get debt on that property. And that debt may be 6.5% or 7 or 8%, depending on what you're buying and how you're financing it. So in this world right here, this is the problem, right? This is what's causing the trepidation and why people are hesitant right now, because interest rates have gone up. And we're not really certain what's going to happen. They could continue to go up. And so that's where I want to focus at, right? That's the foundation of where we are. So to understand whether you should continue to invest or you shouldn't invest right now, we're going to go into a little case study or scenario about how this can work. Over here, it's relatively easy, right? There's a delta there. And when I say easy, I mean like it's just not as challenging as it is now. Obviously, it's a business that you're running in multifamily, so the money doesn't just show up, but it's easier to make money when you have a cap rate that's way higher than interest rate. But over here, not so much. All right, so let's move on into our scenario here. So let me get rid of this. I don't know why this is highlighted like that, but these funky green arrows. Follow me here, but I don't know where that came from or why that's there. Let's see if I can get rid of it. I'm not gonna make it too big of a deal. So just bear with me. We got these little highlights going on here. and we'll hopefully you can still read the text. It is highlighting my handwriting, but we'll keep going, right? So in this scenario, say we're purchasing a property at a $2 million purchase price. All right. So at a $2 million purchase price, if we had a cap rate of 5%, let's sort of walk through the math, right? The formula, NOI over your purchase price, is going to equal your cap rate. These two greens are conflicting right now. It's going to be up. All right. So NOI over purchase price is going to give you your cap rate. In this scenario, this $2 million property was making $100,000 in yearly net operating income. So if we purchase it for $2 million, that's right at a 5% cap rate. All right. And let's just say the interest rate on this was 7%. Okay, so in this scenario, we're sort of set up. Now let's see if we are doing value add investing, right? So value add investing is where we're going to strategically increase the value of the property. So if we were doing a 5% rent increase over the next 5 years, that's approximately $5,000. And this is not, I should have put a little squiggly here because I know there's plenty of smart people here who understand that this is not compounding, right? So it would be 5%. This is just approximately what would happen, $125,000. It'd probably be more like, $127,000, $128,000 in NOI if we did 5% rental increase, which we're just putting that to our top line, right? So what we're saying is year one, it's $105,000 is what we've done to the net operating income and so on and so forth for each other year, right? If the cap rate stayed the same over there, then we would have using our same formula, NOI divided by the cap rate. Well, now that $2 million property that we purchased is now worth $2.5 million. So you have the ability to increase the value of the property, even though you bought it with the interest rate that is higher than your cap rate. Does everybody understand this? If anybody has any questions, feel free to drop it in the chat and I'll go back and sort of answer this once we finish up here. So what you're doing is you're doing a value add strategy in order to increase the overall value of the property. Not to mention that in real estate, you have tax savings, you have depreciation and loan pay down. So if we bought a property at a 5% cap rate, even though it may have a 7% interest rate, we could increase the value by $500,000 on that property. This is what is different about multifamily than, say, a single family, right? In a single family asset, you can't do this. You don't get the opportunity to increase the value of the rents. You have to wait on an appraiser to come out and tell you that, hey, we feel good about the market now. And so everybody else's property is worth more. You don't get to leverage the net operating income. But if you buy strategically using value add investing, you can do these sort of numbers on that, right? And then you combine that with, hey, we saved on taxes, we saved on depreciation, and we also paid down the debt. And so this is the reason why you can still be profitable while buying multifamily. Here's what I say though. It's not as easy as it was up here though. All right. So you're going to be a whole lot tighter if you're in this window right here versus than if you were over here in terms of cash flow. So it's no longer just buy a deal, don't know what you're doing, don't have strong operations and property management. So those days are gone. You really got to dial in after you buy a property to make sure, for one, you execute on your business plan, and for two, that you actually have a business plan that can work. So let me not do that, but I'll stop sharing that screen for right now. So what we're doing right now in value add is still saying, okay, it's not as easy, but it is still possible. All right. So let me go ahead and see if we got a question right. Are people actually buying at a 5% cap rate? Absolutely. So we recently, yep. Good stuff. We got a discussion going over here, right? So I recently purchased a property. I didn't purchase a property. We made an offer on a property. There were like 10 bids and we lost the property for probably like $300,000, right? The one who won offered $300,000 more than what we were willing to pay. So it's very competitive. What's happening now, though, right? So why would anybody buy a 5% cap rate, right? That's a very good question. Well, it's because they plan on doing the value add strategy, or they have a financing or cheaper cost of capital in order to be able to make that deal work, right? Because nobody's just going to buy a cap rate thinking that they can. Now, whether you can or you cannot, that depends on your ability to execute, your ability to asset manage, and overall what's going to happen. So that's where we are. And Jim made a great point. What he said is Jerome Powell said that there will be 2 more rate hikes. And I heard that as well, right? So the last time the Fed was supposed to increase interest rates, they ended up holding them. All right. And so what he said after that is, even though we did not increase interest rates, we plan to increase interest rates, right? And so taking a step back before I show you this next graph, I just want to say that you have to you have to be able to think through these things for yourself, right? Definitely don't just take what I'm saying and say, all right, let's go ahead and buy deals. It still is a business plan that you have to operate. I'm going to go ahead and share the next screen. So what is going to happen with this pause, and will the Federal Reserve continue to raise interest rates, or will they not? Let me share this. So I like Jim, because you're going exactly where I was. All right. So what you're looking at right now, this is the federal funds effective rate, right? And this is going back to, say, year 2000 up until today. And so I thought that this graph was pretty telling, because you have to understand what's happening. So what I'm paying attention to is these sharp increases in interest rates and what has happened historically over that period of time, right? So back here, we had 2000, we had a sharp increase, and then a pause, right, where interest rates just sort of hold, right? They hold those interest rates, and then we get a drastic decline. Okay, happened again in 2004, leading up, and then we get a pause, right? And this pause, this is not like a 1 month pause. This pause can be for a while. But after that pause and we get this plateau, we have a drastic decline in interest rates, right? Same thing happened now. So look where we are here today. Over in 2023, we've gone from right here, just a huge, I mean, we just shot off like a missile in interest rates. And Jerome Powell has announced a pause, but he's also said he plans on increasing, right? So right now we're trying to, not we, right? The Federal Reserve is trying to stop inflation. All right. And so everyone hangs on to Jerome Powell's word as like law. But if he was to come out and stop increasing interest rates and then say, no, we're about to drop them, well, that wouldn't help his cause at all, because the market would reflect that. The market would say, okay, interest rates are about to fall. Everybody, let's start buying stuff. And now we have an inflationary problem. So I'm in no way saying I guarantee the interest rates are going to fall again. I'm just saying that what has happened historically is that there is a pause and then there is a decline, right? And so we just announced the pause. Will it be a brief pause and then we keep going up? That could happen. But is it a pause like one of these others where things sort of stay stagnant for a while and then falls? Well, that's to be determined. All right. And I'm not going to get into a lot of macroeconomics right now. I'll just like showing the data. You do your own research. But why was the pause there for? What's happening in other markets? What's happening with banking? Because if we're still just fighting off inflation, you can just continue increasing interest rates until you get it under control. But there was a pause there. So we'll see what happens if we hit one of these plateaus or not. But something for you to keep in mind. Now, for those who are savvy, who understand blood in the water, where we are, if you're able to buy a deal, right, and I'm sort of hovering over this, in one of these plateaus, and history repeats itself, well, this is where you make a whole lot of money at, right? Because if you buy it at a high cap rate, and then, if you buy a deal when interest rates are high and then interest rates fall, well, now the investor behind you can pay more money for it because he's buying it with lower cost of capital. And you make money oftentimes even with a bad business plan, right? So just sharing the data, not necessarily making any predictions. So, okay, let's go into Jim. Jim says, if cap rates over those 5 years went to 7%, then your 125K NOI to a buyer would only be worth 1.78 million if you were to sell. So you would just hold longer. Yes, great point. So cap rates in the scenario that I did hold the cap rates flat, right? I did not do an increase in the cap rate. So what Jim is saying, if cap rates rise, then yeah, that's going to affect your NOI too. What usually happens is that the cap rate does not go up nearly as aggressively as your interest rates do. So is it possible that the deal would not be as valuable after year 5? Yes. It's also possible for you to just simply hold the deal longer. So we usually project our deals on a 5-year period, but if it's not a good time to sell and you have cash flow, that's what you do. You hold the deal longer until it is a good time to sell and you can hit your projections. And that's why cash flow and the ability to get to cash flow is paramount for you to be able to make a deal work, right? If you're cash flow positive, then you can weather the storm while you do this. And that's the power of value add. So another question from Inde. I simply focus on the stabilized yield of the deal compared to the market cap value add strategy. Yes. So what he's saying is like, hey, I just want to buy a deal that cash flows from day one. I'm not necessarily going to focus on the value add strategy. And that works too. If you can find deals where it cash flows day one, you don't necessarily have to do a lot. Then that is something to focus on. This is what I'll say though. Expenses are going to change regardless, right? So any effective multifamily operator is doing some value add, even if it's not that aggressive, right? Because if you just say, hey, my rents are $1,000 and I'm not going to change them. Well, the tax bill will change. The utility bill will change on you. And if you don't pass that on, you're going to see your cash flow numbers drop. So usually you're tacking on some sort of rental growth, even if it's nominal, right? Even if it's 1% or 0.5% or whatever it is, just to sort of keep up with your expense growth. Let's see, any other comments there? Are cap rates based on location, as in a city, in a general number, right? Are cap rates based on location? Is it a general number? Yes, cap rates are very much varying by the city, the location that you're at. So a New York cap rate will be different than a Georgia cap rate. A San Francisco cap rate will be different than a Oklahoma cap rate. So it is market dependent. All right, so that's all I have. Hopefully I sort of laid this out and just giving you all something to think about, right? Whether you're in the market right now or whether you're not, now you have this information, you sort of make that decision with it. The real takeaway here is that value add strategies, and when you can find a solid value add strategy, it gives you an added level of cushion on your deals, regardless of what cap rates are doing. And this is really all based around your debt, right? So the debt, if you can fix your debt long term, well, now you're able to level a major component of your expenses going forward. And now you got to play with the other numbers. What can you do in rental increases? What can you do in expenses? A lot of people who are hurting right now, a lot of the news headlines that you're hearing right now are people who bought on floating interest rates. And when you saw your interest rates double over that, it's almost lights out for your property because your debt expense has gone up way too quickly for you to be able to keep up with any sort of value add strategy. And there's even some problems with people who are buying deals at floating rates, but now they have to come out into the market and sell because they bought on a shorter term, and they're now coming into a market with 6% interest rates when they bought it short term at 3% interest rates. So it's challenging. Debt plays a major part in this. I'm not going to go into debt and strategies, but that is going to be the determining factor about your overall strategy when you're buying an apartment complex right now. All right. So that's it. Thank y'all for attending this morning. We got a lot of things to decide, and good times right now. I like it because the way I see things, I'm just fairly optimistic as a person, right? When people are running away, those who can figure out a way to stay in can usually do pretty well. Whether that's you or not, that's to be determined. So thank y'all for joining in. I will be here next week with another discussion, and have a good one. Enjoy your 4th of July weekend. See you.